my pleasure to introduce your Executive Chairman, John Welborn, who's going to provide a briefing on the September quarter results. Without further ado, I'll hand over to John Welborn.
Thanks, Dannika, and welcome to the webinar to everyone tuning in either live or watching the replay. An exciting quarter for Fenix as we continue to ramp up from Iron Ridge to Shine to Beebyn-W11 on our pathway to achieve a run rate of 4 million tonnes per annum early in 2025. It was also a challenging quarter for iron ore producers, with the average 62% index price falling 11% in what was a very volatile period for iron ore prices. And I'm pleased that our quarterly numbers show our consistent production and our ability to get a premium from our Iron Ridge product. So our received price was 7% above the 62% index, representing not just the additional grade of our 64% lump and 63% fines product, but also the increasing market view on the low quality, low impurities in our product and the consistency of production at Iron Ridge. The three pillars of our business are all going gangbusters as reported in the quarterly. So if we look at mining, Iron Ridge, we produced on track for a consistent run rate of 1.4 million tonnes per annum. So that was 346,000 tonnes and continued that very high lump content. So 45% of those tonnes were lump and 55% are fines products. And consistent production going well. The really exciting thing during the quarter was obviously we commenced mining at our second iron ore mine in the Midwest, the Shine iron ore mine that we acquired from Mount Gibson. And that is ramping up during the current quarter to our expected run rate of 1.2 million tonnes per annum, on track in terms of budget. So Fenix's ability to quickly and efficiently establish these mines in the Midwest that we can then use our logistics and our port pillars to monetize is being shown in real time in Shine. And then the third part of our mining focus is obviously the approvals pathway for the Beebyn-W11 mine. We have always indicated we expect to achieve all the approvals we need during calendar 2024, such that we can start that mine in early calendar 2025. And that is on track and a very exciting project. It's 20 kilometres away from Iron Ridge, a similar ore body. And we're looking forward to establishing that mine at 1.5 million tonnes per annum. So add those three mines together, and that's our run rate of 4 million tonnes. It's a big step up. We've obviously, as I mentioned, operated Iron Ridge consistently at 1.4 million tonnes per annum. And having got that mine going during 2020 and early 2021, the other exciting element of the September quarter was celebrating the 5 millionth tonne of production from Iron Ridge. Very consistent, very high quality. And we're looking for similar performances from Shine and W11. Our haulage business, so moving on from mining to the second pillar in our business, the logistics function, continues to be a huge value driver for Fenix. And the consolidation and expansion of Newhaul, our logistics function and haulage business, is what provides the opportunity not only to monetize Iron Ridge and capture the benefit of that, but build new production sources at Shine, Beebyn-W11, and the other opportunities that we're looking at in the Midwest. The staff turnover there, the regrettable turnover is at or close to an industry low, demonstrating that we've got excellent people doing an excellent job. Anyone in the Geraldton or the Midwest will see our bright blue shiny trucks driving around, and we've got quite a few of those getting ready and being commissioned because fleet will more than double over the next 12 months as we bring on new haulage operations at Shine and Beebyn-W11. We're recruiting new drivers and new members to Newhaul all the time. And that expansion, both to our depot in Geraldton and the fleet and the drivers, is going really well. Very exciting news for Fenix, for Newhaul, and for the Midwest region in general. Our port business continues to perform. We had a throughput at the port of around 3 million tonnes per annum, slightly dropped off from the June quarter due to the fall in iron ore price and the resulting decrease in some of our third-party tonnages. Iron Ridge obviously being very consistent. And we continue to have lots of latent capacity at our port, and we're looking forward to filling that with future growth projects. We obviously published our full-year results during the quarter and demonstrated ongoing very profitable performance. The quarterly that we've published and we're talking about today shows that our cash balance from 30 June to 30 September went from 77 odd million to 72. We've obviously got a very strong balance sheet. We don't have any senior debt. Clearly, a key element of the full-year results was our decision on this occasion not to pay a full-year dividend. And that was really around funding growth. We've got a $25 million capital spend at Beebyn. We've invested now the $7.5 million at Shine. We're looking at a number of other growth projects. And so we've moved from a harvest mode of Iron Ridge to using that strong cash flow and the balance sheet we've got to develop new mines. But I have confirmed to anyone who's asked that Fenix remains committed to rewarding shareholders. We're building a long-term sustainable business. It requires capital, not just capital in terms of the capex involved in building new mines, but an increase in working capital, and we're looking at further growth opportunities. But our dividend policy is very clear, and when we talk about rewarding shareholders, we are focused on building a big sustainable business, building capital growth, but as well as rewarding shareholders where it's appropriate to do so with dividends. I'm interested in questions about the broader business. It's a very exciting time for Fenix. So back to you, Dan, to answer any questions.
Thank you, John, and congratulations again on yet another outstanding quarter. We'll move straight into the investor questions, and I know you just touched on this, but we've received a number of questions on the strategy for capital allocation and in particular the dividend decision. So many have commented that Fenix continues to generate strong cash flows and held a cash balance of 72 million Australian dollars at the end of the September quarter. Notwithstanding the significant investments in Beebyn-W11, Shine, and the Ruvidini Inland Port, why was there not room for a dividend in FY24?
I think the board have made a prudent and conservative decision around capital allocation. And obviously, you can look at the 72 million at the end of September and say, well, a 2-cent dividend would have been 14 million. There's lots of room. And the reality is the board could have made that decision. Clearly, though, the board are aware of the broader strategy of growth and the opportunities both that we've got in front of us with capital spend, as well as other opportunities that we may be looking at. And we have indicated consistently that there are a number of very exciting business development opportunities that remained under review. So I'd encourage shareholders who are interested and motivated for dividends to understand what's happening in the business. There is capital investment also. Moving from 1 mine to 3 mines requires a significant boost to the capital, to the working capital within the business. And also, at the time of making that decision, we had a great volatility in the iron ore price. So I think the board are confident that we've made the appropriate decision to make sure that we've got funding for the capital projects that we've committed to and are clear and known in the market, and also the flexibility and the opportunity to invest in further growth, as well as to maintain both our existing production from Iron Ridge and our future production from Shine and Beebyn-W11 in any iron ore price environment, recognising that we have seen short-term volatility. So, and just reiterating, we are committed to rewarding shareholders. The board are significant shareholders in Fenix. When in making that decision, we were very cognizant of a very clear dividend policy that says that we will seek to pay a full year dividend subject to the availability of franking credits and the capital requirements of the business. And that's exactly what we've done on this occasion. When it's appropriate to pay dividends, as we've shown in the past, we will seek to do so. We've got franking credits available, and optimistically speaking, clearly at 4 million tonnes run rate in early 2025, the bounce we've seen recently in iron ore prices, and with forecasters like Deutsche Bank coming out saying that they see the potential for iron ore prices to be US $130 a tonne out into 2025, we could be in a very strong position next year. And that'll be a result of the investments we've made this year. So I understand that we have been a strong dividend payer and that there's an expectation that where appropriate, we will pay a dividend. And I can confirm that that's exactly the case. The board are committed to a dividend policy, and where it's appropriate, we will pay dividends when we can.
Yes, and to clarify what you just said, but are there any plans to issue dividends in the future, or will the focus remain on reinvesting capital into growth projects? Or, as you said, are you
yeah, look, I think I'm absolutely happy to clarify that. Where appropriate, we will seek to pay a dividend. The dividend policy has not changed since it was amended several years ago, which moved from a fixed percentage of our net profit after tax to effectively a discretionary dividend. And look, building mines and expanding the business is not a magic act. It requires capital and it requires commitment. We are demonstrating that we deliver exactly the projects we say we will. We did that at Iron Ridge on budget in terms of the feasibility study, both in terms of capital spend and in operating performance. We're confident that we're currently demonstrating the same expertise and diligence with the restart of Shine. And we expect to demonstrate that with the numbers that we will both invest and generate from Beebyn-W11. That will put us in a very strong position to reward shareholders both with capital growth and dividend. It's not one or the other. There's no magic act, though. Building businesses requires capital. We haven't raised any money from our shareholders since 2020, where we raised $15 million to fund the development of Iron Ridge. We're funding growth out of our cash flows. And so there's a capital allocation model that has seen us invest in the company. And we will continue to do so where we see the really stunning internal rates of return that we've generated from Iron Ridge, that we expect to generate from Shine, that we expect to generate from Beebyn-W11. And there are other opportunities out there in the Midwest that we're looking at.
Thank you, John. And moving to a question on Iron Ridge, David has mentioned that C1 cash costs decreased in Q3, and that Fenix maintains a strong operating margin of Australian $46 per dry metric tonne. He asks, how do you see these figures evolving over the next few quarters, particularly considering inflationary pressures?
Look, I think the team at Iron Ridge are doing a remarkable job. I've mentioned before that over the last several years, we've seen double-digit inflation amongst our peers and iron ore producers. And that's a period of time where Fenix has brought our C1 cash costs down from the 90s into the 70s. And again, we saw a small reduction in the September quarter from the June quarter. And that's a great result across our business. Obviously, it starts at the mining performance and then in our haulage and port operations as well. At the scale we operate at 1.4, there isn't any really identifiable huge cost reductions. Obviously, we expect to get a benefit from scale, and we're working on that. And there are opportunities in the future to significantly change our costs. But they relate to changes in our operating model. Currently, we're obviously operating licensed trucks on public roads, and we're operating at low volumes. And we do see an opportunity to significantly boost tonnages and bring our costs down to increase margin. But the first thing we have to do is increase our available mining inventories for that to be real. In the short term, we're focused on building mines at the scale we operate. So to answer the question really specifically, we are motivated, and in our budget, we're looking to maintain our C1 cash costs from Iron Ridge where it is, which somewhat remarkably is actually lower than the anticipated cost in the feasibility study that Fenix prepared for Iron Ridge in 2019. So that's a great job. We're going to continue to look at that. In terms of then the question around margin, well, that is obviously, there's two components to that. One is our ability to maintain or reduce our costs, and the other one is the revenue and price we receive for our product. We've seen another bounce in the iron ore price. It's staying in triple figures, as in $100 a tonne for that 62% index. That's a very strong price for us. We continue to have some hedging protection, and at $46 a tonne for this quarter during a relatively challenging price environment demonstrates what we have delivered from Iron Ridge since we commissioned the mine. We aim to get $50 cash flow margin for every tonne we produce. And that's something that we would love to continue looking forward.
Mm-hmm. Well, that ties in with nicely with some numerous questions that we've received around the iron ore market volatility, and perhaps your strategy to mitigate that via your hedging strategy. So, as you said in the quarterly, the iron ore price dropped about 10% last quarter, but Fenix was able to really outperform that, achieving an average CFR price of $106. One of the questions that I've got noted down from Neil: how does Fenix plan to maintain this price premium amid the continued volatility that we're seeing in the global iron ore market?
The Iron Ridge ore body is a magnificent ore body. It's a big block of 65% iron ore. And one of the things that we've demonstrated and are being rewarded by our customers, which is unusual, particularly for a small-scale miner, is the ability to mine that ore body very consistently in terms of the products we produce, a fines product and a lump product, both in terms of grade and impurities and in size quality. And that's really important for steel making. And so there are two elements to the premium we receive above the index. One is mathematical, because we have more iron content above 62% index. But the other is qualitative, and it's around customer recognition of our ability to blend on the ROM pad into the crusher to produce those quality products. And it's something that starts in our grade control drilling, and Scott Pelleggi and his team on site, and their ability to actually manage the ore body, mine it in a way at small scale that allows us to produce a consistent product. Because obviously, while the ore body is magnificent, there are different zones of that ore body. And so the ability to mine it effectively, efficiently, at low cost, and produce a consistent product is unusual at the scale that we operate. And so that's the way that we get a premium above whatever the index price at the time. It's because we have grade and because we blend appropriately and have consistent product. Obviously, the products that we are producing from Shine will be different, and they'll be priced accordingly. But our ability to manage both the mine production, ROM pad blend, and match the product we produce with the specifications we provide people when we're marketing that product is a skill set that we expect to maintain at both Shine and Beebyn-W11 and the other mines that we operate, as well as one aspect of our haulage operations and the ability we have around the infrastructure we have at the port is that we really manage the product not from the mine all the way through to the ship. And so we make sure that our lump products aren't degrading and we're not getting penalties for fines developing the lump. The new haul trucks aren't shaking around, even though it's got a very long haul. If anyone's followed those trucks in and around the Midwest, the entire 60-metre quad road train is incredibly stable. And that means the ore isn't getting agitated and breaking down. Similarly, we have the ability to load our trucks directly into our sheds and directly onto the ship, all of which preserves the physical characteristics of the ore, which then flows through into the price we receive. So that's, there's a little bit of science around how we make sure that our products are well received in the market. And then obviously, like every commodity producer, we ride the wave of the global commodity boom. That's what makes it interesting. You mentioned we have a hedging policy. We continue to look at that. It was very important in the early stages of Iron Ridge. We've done a number of things to future-proof our future margins, most notably at W11, where the way that right to mine works with Sinosteel, actually provides us a return on the use of our logistics, which is unrelated to the iron ore price. Similarly, in our third-party business, we're obviously making a margin that's unrelated to direct exposure to the iron ore price. So as our business grows, we become slightly less directly exposed to the vagaries and the volatility in the iron ore price. And one thing I always talk about with hedging is that hedging doesn't change, that the number one driver of margin for a miner is to bring your costs down. And that's what we need to do. That's why we're expanding in the Midwest. It's why we're hanging on to capital so we can grow, because we do see a very exciting pathway to produce a sustainable, low-cost iron ore miner in the Midwest. And that's about volume as well as the style of production and the style of our logistics. We are currently a small-scale, relatively high-cost miner. Now, we've developed and proven, as we did in this quarter, that business can generate a $46 a tonne cash flow margin. But in future, we expect to bring our costs down, and that's the number one hedge. And the way we do that is manage our ore bodies well, control our costs well, and focus on product quality.
Mm-hmm. And on your growth strategy for increasing production, you had a very exciting milestone in the quarter with Shine iron ore mine activities commencing in August, and with expected production, I think, in late October or early November. There's been a number of questions come through, and perhaps you can speak to what the stages look like in terms of production profile and product mix. A couple of questions that come in on the Q&A feature. And also, are there any challenges or risks that investors should be aware of that you maybe foresee in ramping up to full production?
It's a great question. Starting mines is difficult if you look at the track record of the entire industry, particularly small-scale explorer developers. You know, I don't think many companies ask people to reconcile their performance with their feasibility study published 5 years before they are currently producing. So, you know, Fenix continues to be an outlier, I believe, in terms of our performance between expectation and delivery. And it's something that as a management team and a board, we really focus on. We want to deliver on exactly what we say. So look, I think the risks of developing mines are well known by the market. You can have capital overruns, you can have time delays, which is really the problem in the industry at the moment, particularly with greenfields projects and the difficulties in approvals, in heritage clearances, in negotiating with pastoralists and all those issues. So timeline delay, capital delay, and then operating costs, inflation, as well as all the vagaries of challenges and risks of mining, grade dilution, strip ratio changes, and the fact that there is a little bit of a dark science in terms of ore body estimation and the reconciliation between you know, a JORC-compliant mineral resource and what's actually in the ground. And then in the bulk commodity mine, obviously the most of our costs are actually in logistics, and that's a separate business, and then access to port and all of those things. So while identifying those risks, I'd point out that what we're doing, we demonstrated that we manage those risks very effectively and unusually successfully at Iron Ridge. And we want to do that exactly the same at Shine. We're very well advanced at that. We know that the capital spend of the restart at Shine is on budget because we've done it. And we expect that that mine will produce 100,000 tonnes of ore per annum. And we've done a lot of grade control drilling over and above the work that Mount Gibson did to make sure that we understand the ore body and understand the products we're going to produce. And then we're well advanced with our approval process from W11. So what we're demonstrating, I believe, is we manage those risks and we deliver projects to expectation.
Okay, thank you, John. And moving to Beebyn-W11 and the development there, can you provide some more insight into the regulatory and environmental approvals that you just touched on for Beebyn-W11 mine? And are you confident that production will begin in early 2025 as planned?
Well, we're as confident as we can be, and we've maintained the timeline that we indicated, I think, when we signed and announced the right to mine from Sino. It was an ambitious timeline then. It's much less ambitious now because we've advanced with all of the approvals that we require. We lodged our mining license approval in May. We expect to receive that during this calendar year, hopefully within 6 months, which would see us receive that in December. We've negotiated a deed of covenant on the existing Sinosteel native title agreement. And one of the things we announced in the quarterly is that we're on track with all those other approvals. So we're as confident as we can be. Obviously, we need to secure those, but at this stage, we're gearing up to starting mining activity in early 2025 and ramping up as quickly as we can to a run rate of 1.5 million tonnes per annum. It's, you know, this is an ore body that has a lot of similarities to the Iron Ridge project when Fenix set out to achieve all the approvals and start the mine. It's a greenfields project. It's 20 kilometres away. Just like at Iron Ridge, we need to build a haul road to the mine. We need to mobilise a crushing and screening plant, and we need to get into what at the early stages will be a very low strip ratio ore body. It's an exciting project. It provides lots of growth opportunities because you know, I've been quite clear that I see success at W11 as you know, the key to the broader opportunities in the Sinosteel portfolio in the Weld Range. They have almost 300 million tonnes of stranded direct shipping ore in and around us in the Weld Range. And so, you know, they are an inception partner of Fenix. We acquired our smallest shed at the port off them. They've been an offtake and marketing partner for 50% of the products from Iron Ridge, and we're now working with them to develop the W11 mine. We have a right to mine. We're in control of that project, and we believe that success will expand into the Weld Range. So it's very important that we focus on it. Goran Seat and his team at Fenix are doing a great job, as are Scott Pelleggi and the Iron Ridge team in getting ready. We're expanding the camp in preparation. We've got a tender out for the mining proposals. And stay tuned for further progress during calendar 2024, such that we do start mining in early 2025.
Excellent. Thanks, John. And what specific logistics efficiencies and revenue streams do you anticipate unlocking once the Ruvidini inland port becomes operational? Keith has asked a question, how does the timeline for government approvals align with your growth projections? And can you please provide an update?
Look, Ruvidini is a really strategic asset. You know, just a reminder for people who aren't aware, as part of the acquisition of Mount Gibson Mining's Midwest infrastructure, and Mount Gibson have been traditionally the most successful miner in the Midwest. We obviously are proud of our 5 million tonne recognition from Iron Ridge, but Mount Gibson mined 50 million tonnes from Tallawarra Peak and Extension Hill, and we acquired the legacy infrastructure that production developed. Large on-wharf storage facilities at Geraldton Port, the infrastructure that connects them, matches very well with our existing truck unloader and shed we acquired from Sinosteel. We acquired, as part of that deal, the Shine Iron ore mine and 2 rail sidings, Ruvidini and Perenjori, which in their production, Mount Gibson hauled from Tallawarra Peak and Extension Hill to the Ruvidini rail siding, the Perenjori rail siding, and then used that facility to deliver the ore into the on-wharf storage facilities at Geraldton. We have that opportunity in future. Our actual new haul logistics business is actually cheaper than the Midwest rail network, which is why we're currently not accelerating rail as an option, but we will when our tonnages grow. And equally, so Ruvidini, first of all, is a great option to transition our production and haulage from road haulage onto the rail, particularly for that very built-up area heading to that last 100 kilometres into Geraldton. So it's effectively moving our delivery point on road, potentially, from Geraldton in the middle of the city to 100 kilometres away at Ruvidini. It also provides us the opportunity to stockpile third-party product, which is why we've developed the radial stacker there and an opportunity. So it allows us to get on rail. It also allows us to have third parties deliver product, which we can then haul into our sheds very efficiently in order to ship load, rather than having to build those ships in our limited port space. So it's an investment around future growth. It provides us opportunities to grow our third-party business. It provides us opportunities to significantly grow our own tonnes when that's possible, looking ahead at where we might be producing more along the lines of what we think our port facilities can do, which is north of 10 million tonnes a year. And when we're at those sort of volumes, a lot of that material will be coming in by rail. And so one way of looking at our investment in Ruvidini, it was motivated by the $70 million logistics contract we signed with Gold Valley. And when we commission the Ruvidini Inland Port, its main customer will be Gold Valley and the tonnes coming from their Wiluna operations. But it's also an investment in the future of Fenix and what we see the Midwest and its capability for bringing lots of product into Geraldton. That, as we announced in the quarterly, we substantially completed the project. We're working with ARC to establish a rail crossing, which will allow our quad road trains to access the site and start that haulage. And we expect that will be in 2025 when that occurs.
Okay. And so you've mentioned your growth outlook for the iron ore production profile for Fenix, but what about other growth strategies outside of iron ore and potentially? Vaughan has asked, he wanted to know if there's any plans in the pipeline to potentially mine other commodities in the Midwest region and what those growth opportunities might look like.
Yes is the short answer. If you've looked at our investor presentation, and I'm sure many shareholders listening to this webinar have, you'll note that we identify all the projects in the Midwest that are currently doing feasibility studies that we see as being relevant to bulk commodity export from Geraldton. And there's more than 100 dots on that map. And obviously, some of them are iron ore projects, but the majority of them are other commodities, including obviously magnetite, manganese, lithium, spodumene, vanadium, talc, garnet, silica sands, potash, a whole range of commodities. And so there's two ways that Fenix is looking at those. One is as a miner. Obviously, we have skills in mining iron ore, but we think those skills are replicable to other, what we would call simple bulk commodity mining. And then also in our third-party business and unlocking the significant strategic element of haulage and port services for other miners in the region. We've done some small deals like we did with 10M. We made a very small investment in terms of a convertible note in Athena, what we believe is the highest quality magnetite project in the Midwest. And we're looking at others. So yes, I think at a very high level, what history tells you is that, and I mentioned this in relation to Mount Gibson, iron ore is a commodity that works, and we're absolutely convinced we're going to make a lot of money, as we have demonstrated already with the operation of Iron Ridge. We see huge future profitability out of iron ore in the Midwest, and in terms of the investment that's been made in exploration and the available tonnes, there is no doubt there is a long-term, sustainable, profitable business in iron ore in the Midwest for Fenix. But we also see in all the commodities I mentioned a constraint in terms of production and particularly export in the current port environment. We provide those producers, if and when they're ready, with an available solution. So the answer is, why haven't we seen more third-party commodity business in our logistics functions? Is, well, we're waiting for those miners to develop their mines and have product that we could haul for them and export for them. And we're looking at a number of those things, but the opportunity to diversify is there, and where appropriate, we'll look to monetize those deposits.
Perfect. Okay, thank you, John. There's a couple of questions on Iron Ridge exploration. I'll ask one from Roger, who would like to know when the assay results from the July exploration drilling at Iron Ridge, if they've been received, and if there's anything else that can be looked at within the Scorpion tenement.
Like you, Roger, I'm waiting with bated breath for those exploration results. It's the first step of expanding Iron Ridge. We haven't done any exploration as a company since we started mining, and there's obviously a huge value add. clearly we're constrained by heritage, the value of heritage in and around us. The ore body does extend at either ends into areas that we will not mine, subject to our agreements with the Wadjuri people. But there are significant areas, obviously the assays we're waiting are in zones where we could possibly find oil body extensions that are mineable. And we've also got one further area that we expect to drill early in 2025 that will provide possible ore extensions. So we'll obviously announce those assays when we receive them and where material, and look to advise on any extensions at Iron Ridge as we look around. And that's the most obvious exploration for us to do.
Okay, perfect. Thanks, John. And on third-party logistics expansion, which you touched on previously, what is Fenix's long-term strategy for expanding that third-party logistics services business, and particularly in the context of new or potential agreements or contracts that you might have, and noting that the third-party iron ore shipment volumes did decrease last quarter?
So there's two obvious opportunities. We want to maximise the throughput, and so start at the port and work backwards, because there's no point hauling more material than you can export. So we're doing a number of investments in the current quarter to increase the efficiency of our very large storage opportunities at the port. And if you've looked at those slides on our presentation, you'll see that we have 3 separate storage facilities. We're working to link all of those to both the Midwest Port Authority rail unloader, as well as our truck unloader, or potentially new truck unloading, which provides us greater capacity. In the long term, we see that capacity can extend beyond a throughput of 10 million tonnes a year. So the answer to the question, what's the strategy in our logistics function, is to maximise that throughput and build a 10 million tonne a year business. From a Fenix perspective, obviously, first prize is that all of that material is our own. But it takes time and capital to develop mines. And so we're also very interested in unlocking capacity for other people. We're motivated to do so. Geraldton Port is a multi-user port, and where there's available capacity, we'll fill it as quickly as we can. And that's why we're looking for third-party customers. And we've demonstrated with our arrangements with Kufi, with Gold Valley, with 10M, that where people have got material that they're mining and they need a solution, we'll provide it.
And Keith has asked, to support the growth ambitions, do you need Oakajee Port to go ahead, or will Geraldton Port be able to cope with the increased traffic?
The development of large-scale iron ore mines in the Midwest has only been constrained by a view that the exploitation and monetisation of those high-quality deposits required 2 things: a new bulk commodity railway and a new bulk commodity port, which was the Oakajee Port and Rail network, as well as other regions, as we've seen new proponents in the Pilbara use both historically and more recently. We believe the Midwest is different. What we're demonstrating in Newhaul is part of an industry realisation that in some ways, rail is effectively, modern rail is a version of 18th century choo-choo technology. We think there's a lot of opportunity to actually deliver a lot of tonnes very cheaply using private haul roads, big road trains, autonomous and potentially hybrid fuels, and other opportunities. So we believe the development of the Midwest, potentially doesn't copy the development of the Pilbara. That's a much longer term view, but the shorter answer is we believe, as I've said earlier, that we can do more than 10 million tonnes a year from the existing port of Geraldton. At the moment, Iron Ridge is producing 1.4. Early in 2025, we'll be producing 4 million tonnes per annum with the successful development of Shine and W11. Further projects coming online. It's a long, long way until we say, right, we need to build a new port at Oakajee so that we can go to 20 or 30 million tonnes a year. A 10 million tonne a year business is a very, very big business. And Geraldton Port, the existing port, and I'll make the point, if shareholders want to verify that sort of tonnages, go on the Midwest Port Authority project website, look for the PMAX project, the government have allocated several budgets ago more than $300 million to develop that project. It very clearly identifies what they believe that export volumes will go to out of Geraldton Port, and those volumes are more than consistent with what we're talking about at Fenix.
We've run a little bit over time, but I was hoping to throw a wildcard question at you, John, from T, who's asked, is Fenix a takeover target? I actually haven't heard this question before, but I thought you might have an interesting response, so I'm going to
Look, we're pretty excited about what we're building at Fenix. Obviously, we're back in that sort of 20 to 30 cent trading volume, which is in one sense very disappointing. I think our market, when we've just snuck into the top 100 index of listed companies with our current market cap, I think that in the short term delivery of our projects, you would think would justify a re-rate. The market is efficient. I think we will be rewarded for our profitability and our growth potential. At the moment, I went to Africa decades ago because I thought you had to go to far-flung places to find amazing opportunities, particularly in the resource space. The great personal realization in what we're doing at Fenix is that in effectively having grown up in Perth, in my backyard, there is this amazing opportunity. Hundreds of millions of dollars, if not billions, have been spent on exploring and discovering and defining this opportunity of building a major exporter of valuable commodities, obviously iron ore, but others in the Midwest using available infrastructure, roads and port. And so that's what we're doing. At the moment, we're a very small business and we need to grow, and hopefully we will capture attention. But the number one support we're looking for at the moment is from our shareholders, and we want to deliver them value.
Thank you, John. Well said. To wrap up with, are there any final comments you'd like to leave investors with on the forward outlook for Fenix?
I think we've summarised it in the quarterly with that pathway to 4 million tonnes a year. I think people we're aware that we've been very successful at Iron Ridge. That in itself is unusual, being an explorer developer and effectively building a mine. It's even more unusual to then replicate that. And in the very short term, we're getting close to that end of the year period. We're in the last quarter of 2024. In early 2025, we do expect to have delivered on our expectations, and we think that's going to lead to reward. And so we look forward to updating the market and being held accountable for that pathway.
Certainly an exciting growth trajectory ahead. And I want to thank you, John, for giving a very detailed presentation and answering all those questions I threw at you. And also thank you to all the shareholders and potential investors that joined today's webinar. If we didn't get to your question or you have a follow-up query, please feel free to reach out to John or myself. Our email is on the bottom of the ASX announcements. Thank you again for joining.
Thanks, Dan. Thanks, everyone.